Hey everyone! Today, we're breaking down a simple, effective way to invest your hard-earned money mutual funds. Think of mutual funds like baskets of stocks or bonds. You're pooling your money with other investors to buy into a diversified portfolio managed by professionals. Less headache for you, potentially better returns. In this video, we're diving deep into the four main types of mutual funds: growth funds, income funds, balanced funds, and money market funds. We'll unpack their goals, risks, potential returns, and who they're best suited for. By the end, you'll know exactly which fund aligns with your financial goals. Let's get started. Alright, let's talk growth funds. These bad boys are all about one thing: capital appreciation. They're like that friend who's always chasing the next big thing. Except in this case, it's companies with massive growth potential. Think tech giants, innovative healthcare companies, those sorts of disruptors. Growth funds are considered higher risk because they're heavily invested in the stock market, which can be volatile. But higher risk often comes with the potential for higher returns over the long haul. You're a young professional just starting out. You've got time on your side, and you can handle a few bumps in the road. Growth funds are perfect for this stage because even if the market dips, you've got years to recover and let your investments grow. Companies like Amazon, Tesla, and Google are typical investments for growth funds. They might not be paying huge dividends right now, but their stock prices have the potential to skyrocket. Growth funds are a long-term game. If you're patient and let compounding work its magic, you could see some serious returns. Stay informed, stay patient, and watch those investments grow. Alright, let's shift gears and talk about income funds. These are the reliable, steady-as-a-rock investments in the mutual fund world. Income funds are all about generating regular income for investors. Think of them like your trusty dividend stocks. But instead of individual companies, you're investing in a diversified basket of bonds, real estate, and other fixed income securities. Because income funds focus on stability and consistent payouts, their potential for massive growth is lower compared to growth funds. But that's not necessarily a bad thing, especially if you're at a different stage in your life or have different financial goals. Income funds can provide that steady stream of cash flow to help cover living expenses, travel, or whatever your heart desires. They can also be a great option for risk-averse investors who prioritize capital preservation over high-flying returns. Income funds typically invest in things like government bonds, corporate bonds, and real estate investment trusts, REITs. These assets tend to be less volatile than stocks, meaning they're less likely to experience those wild price swings we see in the stock market. So, while you might not see your investment double overnight with income funds, you're getting that peace of mind knowing your money is working for you, generating regular income with relatively low risk. If you're looking for a way to generate passive income, diversify your portfolio, and sleep soundly at night, income funds could be a great option for you. Chapter 3. Balanced funds, the best of both worlds. Let's talk about investors who want to have their cake and eat it too. You crave growth potential, but you also want some stability in your life. Well, my friend, let me introduce you to the magic of balanced funds. Balanced funds, also known as hybrid funds, are like the Goldilocks of the mutual fund world. They aim to strike that perfect balance between risk and reward by investing in a mix of, you guessed it, stocks and bonds. Think of it like this: you're building a delicious meal. You want some flavorful, exciting ingredients, stocks, for that growth potential, but you also need some hearty grounding elements, bonds, to keep things stable and satisfying. That's precisely what balanced funds do for your portfolio. The exact ratio of stocks to bonds in a balanced fund can vary depending on the fund's specific objectives and risk profile. Some might lean more towards growth with a higher allocation of stocks, while others might prioritize income and stability with a larger bond component. The beauty of balanced funds is their flexibility. They offer built-in diversification, which means you're spreading your risk across different asset classes. This can help cushion your portfolio from market volatility and potentially smooth out those returns over time. Balanced funds are versatile, adaptable, and can be a great option for a wide range of investors, from those just starting to build their portfolio to seasoned investors looking for a well-rounded approach. However, it's important to remember that even with their balanced nature, these funds are not entirely risk-free. Chapter 4. Liquidity, Money Market, Funds, Your Financial Safety Net. Let's talk about those just-in-case funds. You know, the money you need to have readily available for emergencies or short-term goals. That's where liquidity funds, also known as money market funds, come into play. Think of them as the financial equivalent of a warm, comforting blanket on a chilly night. Liquidity funds are all about safety and stability. They prioritize preserving your capital above all else. They're designed to maintain a stable value, so you don't have to worry about your investment losing money, even when the market throws a tantrum. Because of their focus on capital preservation, liquidity funds typically offer very low returns. Don't expect to get rich quick with these. Their primary purpose is to keep your money safe and easily accessible when you need it. Liquidity funds invest in super safe, short-term debt instruments like treasury bills, certificates of deposit, CDs, and commercial paper. These are about as close to risk-free as you can get in the investment world. Liquidity funds are a crucial part of a well-rounded financial plan, providing a safety net and ensuring you have access to cash when you need it most. There you have it. We've broken down the 4 main types of mutual funds: growth funds for those chasing long-term capital appreciation, income funds for steady income generation, balanced funds for the best of both worlds, and liquidity funds for your short-term needs and financial peace of mind. Remember, the key to successful investing is understanding your own financial goals, risk tolerance, and investment timeline. Once you have a clear picture of those factors, you can choose the type of mutual fund that aligns best with your individual needs and helps you achieve your financial aspirations. Don't forget to do your research, compare different funds, and consult with a financial advisor if needed. Investing can seem daunting, but with the right knowledge and approach, it can be an incredibly rewarding journey. Thanks for watching.